Good morning, guys. I hope you're well. Um, we are going to do our very last video now, which is video number 4 on the Northwest Prelim paper for the year 2023. So, as I've said earlier on, I'm only going to be focusing on things that we have not done either in the Eastern Cape or in the Free State Prelim paper as we are moving forward. I hope that you guys are studying and you're making progress in your studies. All right, so one of the questions that we are going to look at is question 3.2.2, which is dividends and returns. It says, compare and comment on the dividend payout policies of the two companies with figures. So here they want us to comment and compare on the dividend payout policies of the two companies. And then they say, comment and explain the percentage return on shareholders' equity for each company. Let's start with the first bullet, which has to do with the dividend payout policies. So when we come here, we are looking at the two companies. Remember, it is Wild and Free. So if we are to comment on the dividend payout policies, the first thing we need is the dividend payout rate. From the rate, then we can deduce the policy. So we'll start off first with Wild. And when you look at Wild, their DPS is 520 cents. So you say 520 over the earnings per share, which is 1,300 over 1,300. You multiply this by 100 over 1, and this will give you 40%. In other words, they're giving 40% of their earnings as dividends. They're giving 40% of their earnings as dividends. Let's come now to Free. If you come to Free, they are giving 450 and then as dividends, and then their earnings were 500. And then you multiply this by 100 over 1, and then you will get 90%. So what this means is that they're giving 90% of their earnings as dividends. All right, let's see if we can then have a full comment on this question. All right, so let's see if we can just do this so that we can then have a comment here. All right, so remember we've just calculated, and then what we now want to do is to have the comment. All right, so we are now saying that Wild Limited has a dividend payout policy of 40%. Remember, we calculated that one. This policy is better for those investors who are looking for future growth. I think it was in the Free State or the Eastern Cape where I saw they were talking about long-term investors. Okay, so this is good for those long-term investors, people who are looking for future growth, because they're retaining funds for future expansion, which can lead to better returns in the future. So you need to look at the Free State paper again, where they talk about what we're calling long-term investors. All right, so the moment a company is retaining more, this is good for its long-term investors, because this company is thinking about the long term. They're thinking about future growth. They're thinking about expansion. And then if you come to the next point, it says investors who are looking for an immediate return. So here we're talking about short-term investors now. Short-term investors. If you go again, I think it was the Free State, if I'm not mistaken, they were talking about such. So for the short-term investors, they will get an immediate return, which will probably be happier. So with Free Limited, they are paying 90% of their profits. That is 9% of their earnings is being paid as dividends. So for short-term investors, this will be something very good. They are not retaining much of their profits for future growth, as they want to satisfy or appease their shareholders. All right, so I think you have understood that part there. Let's see if we can quickly run to the next question, which was now saying comment and explain the percentage return on shareholders' equity for each company. Okay, All right. So if you come here now on commenting on the shareholders' equity, on the percentage return rather, on shareholders' equity, you will see that the percentage return for Free Limited, percentage return on shareholders' equity for Free Limited is 13.9, and for Wild it is 16.2. So that is what we are having here. So remember, they didn't want us to calculate this, they wanted us to comment. But the moment you see the percentage return on average shareholders' equity, there has to be something that comes to your mind already that you have to compare this with. That is your return on alternative investments. So for you to get alternative investments, you are looking at the interest rate of fixed deposit. This is your alternative investments here. Okay, so what we are saying is, if an individual invested in Free Limited, they were getting a percentage return on average shareholders' equity of 13.9%. If they'd invested in fixed deposit, they would have got 7%. So that is what we want to compare and comment on now. So when you come here now, this is what the examiner would have wanted you to say, that as you are commenting on both, remember Wild it is 16.2 and Free it is 13.9. Comment and explain of each company. So you have to mention both companies here. So hence you see Wild there and Free there as well. And then both companies are earning returns that are higher than most of the alternative investments, such as fixed deposit. Okay, so this is good that these companies are giving a return which is higher than alternative investments. Remember, it is very important that whenever you comment on your percentage return on average shareholders' equity, you compare it with your alternative investments. All right, so I'm just going to quickly come and do probably the last question here. Then we're going to close this video, and this will be the last video from this paper. 3.2.3, risk and gearing. Risk and gearing. So I've seen that most examiners are bringing this question in this very same way. So if you master it from all these past exam papers, you should not have a problem. Comment on the risk and gearing of each company. Comment on the risk and gearing. Risk and gearing. So you can see here, these are two elements that we have to comment on. Quote two financial indicators with figures to support your answer. All right, so the moment we talk about the debt equity ratio, remember we're talking about risk. All right, so the debt equity ratio is 1.8:1. So this is on Wild Limited. If you come here, Wild Limited, the debt equity ratio, it is 1.8:1, whereas the one in Free is 0.2:1. Okay, and then if we had to comment there, you would then say Wild is in a high risk position. There is high risk in Wild. It is highly geared, whereas if you look at Free, there is low risk, that is, there is low gearing. All right, so I'll say it again. In Wild, there is high risk. We're talking about high gearing. It is highly geared, whereas when you come to Free here, there is low risk because it's 0.2:1, so there is also low gearing. Then the next part of the question, we are now looking at the ROTCE. So it's going to be the ROTCE for Wild. That is the return on total capital employed. The return on total capital employed, it is 13.4% here. That is your 13.4%. And for Free, it is 13.2%. For Free, it is 13.2%. Now, if you then comment on this, you have to bring in now the interest rate on loans. Interest rate on loans. There it is. So you are now saying the return is 13.4. So companies are both experiencing positive gearing. When you talk about positive gearing, you're simply saying your ROTCE is higher than the interest on loans. Your ROTCE is higher than the interest on loans, which is 9.5%. So the moment your return is higher than the interest rate on loans, then you are positively geared. But if the ROTCE was lower than the interest on loans, then we would have been negatively geared. So in this case, both companies are getting 13.4 and the other one is getting 13.2, which is higher than the 9.5%, which is the interest rate on loans. Therefore, the companies are positively geared. So you have to draw a line between positive gearing and high gearing. High gearing, risk. Positive gearing, we are now talking about the difference between your ROTSE and the interest on loans. Okay, so I'm going to close this video, guys. Okay, I hope you're studying. Please keep pushing. Until we meet again next time, goodbye.